And I think having, assets in different buckets, diversification investment-wise makes sense,
Yep.
but diversification tax-wise makes a lot of sense.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters here with John Martfeld.
Good morning.
We're missing Lee today. He's out doing
Fun stuff.
Yeah, he's actually up in New York City. He's going to catch the Hogs Michigan game tonight at Madison Square Garden. So
pretty cool.
Hopefully that goes well for the good old Hogs. Speaking of sports, Isaac actually just sent this over to us. He sent us a link. But the big news in the last day or so was Juan Soto with the Mets. Signed a $765 million deal.
It's unreal.
$765 million deal to play baseball.
That's unreal. He might be able to make that last the rest of his life.
Good for him. Yeah. 15-year deal to play for the Mets. So
that'll be like 40 something when he's done, which means that deal will end up not working out great for the Mets.
Sure.
But for the next 5-10 years, probably be great, and then he'll fall off.
Right.
But anyway,
yeah, that's pretty incredible.
It's incredible how much money is made by these guys that it's unbelievable. And if you compare that to like Tom Brady's lifetime salary, it's amazing. It's
dwarfs.
Yeah, it's crazy.
Yeah. Well, that's not what we're going to talk about the entire podcast. So today we're going to talk about charitable giving. So just some general charitable giving statistics, kind of like how much money is given, what does that equate to in terms of percent of people's incomes, different ways that you can give, in a tax efficient manner. And then we're going to roll into, from there, we're going to talk about some pros and cons to deferring income. So, making contributions to a 401k, contributing to a deferred income plan if you have that offering at work, and when that might make sense and when it might not make sense. So to start, I'm on the npttrust.org. It's charitable, the National Philanthropic Trust, charitable giving statistics. So this is for 2023, right? Since we don't have full 2024 numbers, but in 2023, Americans gave $557 billion, which reflected a 2.1% decline from 2022. In 2023, the majority of charitable donations went to religious organizations, so that made up 24% of the giving. Human services, 14%, education, 14%, grant-making foundations, 13%, and public society benefit, 10%, which I have no idea what public society benefit
I'm not sure
means. But giving in 2023 increased in many sectors, double-digit growth for foundations, public society benefits, education. Giving declined precipitously to individuals. That's not my word. That's the article's word. So what does that mean in terms of percent of people's income? I was looking at various sources, and it said the average American gave, it was around like 2% of their income over the course of the year to, various nonprofit organizations. According to the most recent data, the average yearly charitable donation is approximately $3,296. The average charitable donation, the average charitable donor in the U.S. is 64 years old.
Interesting.
That is interesting. It makes 2 charitable donations a year. Younger people want to forge their philanthropic identity separate from their parents. At 88% of young women and 69% of young men surveyed, and the majority of donors, 64%, prefer to give online with either a credit or debit card. So, the long and short story here, this is not what we're going to get stuck on, is a lot of money is given. $557 billion is a lot of money, right? But when you look at the total income of the average American and, the U.S. population on a percentage basis, it's pretty low.
It's pretty low, yeah.
I know a lot of people that don't give at all, right? And I know that 2 to 3% average is it's only that high because of some of the super generous people that give high levels, right, and large percentages.
Exactly.
But I know there's a lot of people that don't tithe at church, and this isn't trying to call anybody out. It's just stating the facts. And here at the end of the year, as we're in the middle of the Christmas season, and talking about charities and churches, a lot of churches doing Christmas offerings, trying to raise support for various mission projects that they I think it's an important conversation to have, to just encourage people that, we talk a lot about it here. We talked about it at our staff Christmas party the other night. It's like, living life like a stream or a river where, you trust that the Lord will replenish.
Right.
And you just are the conduit for
not a
those
pond.
resources, not a pond where, the water comes in and it just sets and gets stagnant. So I think as a believer and as a firm that tries to live and operate by those values, it's important to encourage each other in that way, because we're all human and it can be easy to kind of get complacent.
Well, one thing I know Matt doesn't like talking about this, but he's the CEO of the company, and we've got Lee, who's usually here as a president. We've got the founder, David Lee. They have done a great job of we give to 5 different organizations, and this year we're giving quite a bit, and it's a percentage of GDP of our revenue.
Right.
But it's pretty fantastic, and I don't know if you want to give the numbers or share the numbers if you can, but it's amazing that we do that, and you guys are humble about that, but it's awesome. Also, you think about tithing. If you tithe to your church, tithe is 10% basically, and when we do financial planning, we kind of our clients, whether they like it or not, are going to see that as our top line item of spending.
It's just a reminder. Giving. We're not going to push or tell everybody they have to, but
we're not judging.
We have it up there as like, hey, this needs to be front of mind. However you decide to act on that is your decision, and we're not going to get involved in that too much. But we want it to be up there as a reminder. This needs to be a line item.
It does, and the other thing, the nice thing about it, sometimes you can charitable give. And there's benefits to charity. I mean, I'm not even trying to be, other than you're getting a few extra notches for heaven potential. But you can have tax write-offs like using the QCDs, where if you're having, which is a qualified charitable distribution from your IRA,
right?
Which if you don't need them, for example, if you don't need to take the money, but the government's forcing you to because you're of age and require minimum distribution, you can give that to a charity and avoid some of the tax issues to yourself.
Right.
There's quite a few ways to
so if you're 70, so what John's referring to is if you're 70 and a half, so it's kind of different because the RMD age is 73, but this age stayed at 70 and a half. You can start doing what are called qualified charitable distributions out of your IRA, and the benefits of that is you can send the money directly from your IRA to your church, the charity of your choosing, any 501c3 nonprofit organization, and that distribution does not show up on your personal tax return. And so it makes a lot of sense, in particular for people that take the standard deduction, because what that does is it keeps your it keeps your top line income lower,
right? And
so then when you apply the standard deduction, it has a greater impact on that. And so if you're charitably minded, which we hope that you are, that's a great way to give if you're of the age, if you're at 70
and if you're not
half.
charitably minded, but you don't want to take the IRA distribution and add it to
and
your
have
taxes,
to pay taxes, then it's
and
still
you don't know what to do with it. It's a great solution
Right.
to not have to pay taxes, and you give that money to a better cause.
So you've got QCDs, you've got you have donor advised funds. That's a great way
fantastic.
to lump multiple years worth of giving into a single year, if it makes sense. So where we look at this from a planning perspective often is if someone's in, for whatever reason, they're selling a business at the end of their career, or they're later in life, and it doesn't have to be later in life, but you have high income years that are going to be followed by lower income years, right? You're retiring or whatever the case may be. And in that higher income year, every deduction is super valuable, right? And so can we pull forward some giving that we're going to be doing over the coming years in those years where income is lower? Can we pull that forward into 1 year? And so what you can do is open a donor advised fund, fund that account, get the deduction for it all in 1 year, and it's irrevocable. You can't change your mind later.
Right.
But you get the deduction for it in 1 year, but you don't actually have to distribute the money to charity. So you can use that fund, that account, for upcoming years, tithes or whatever you're going to do, and send it to the charities down the road. And while it's in there, it can remain invested. Yeah. So that's a great way to do some tax planning for someone in
Roth
the right
conversions
situation.
Or higher tax years.
Or if you want to do Roth conversions and you want to combo that with a donor advised fund contribution. And then the other one, there's quite a few different options, but these are kind of the main three that we run into, is just gifting highly appreciated stock, right? We live in an area where there's some large organizations and people, their equity compensation is a big part of their compensation. And so we run into it all the time where people have highly, highly appreciated, Walmart,
Stock.
J.B. Hunt, Tyson stock, and others. And you don't want to sell it because, you got $1 in it and it's worth $12. It's expensive to sell it from a tax perspective. So you can send those shares directly to the church or charity of your choosing, get credit for it, but you don't have to sell it. So you don't have to pay the tax,
which is
bill.
Really a fantastic way.
Absolutely.
If you are charitably inclined, that's a great way to dissolve big, high cost.
And I always look at it like a win-win. That and the QCDs, because what most people do, and I'm not saying this is wrong, but by any stretch, but what most people do is they take the distribution or they sell the stock, they pay the taxes, and then they gift the net amount.
Yeah.
In this situation, you're able to gift or give the gross amount tax-free, which is a win-win for both you and the charity.
Yeah, I think it's a great thing. I think a lot of people, that's one area I think we can help a lot of people. I don't think that's widely known or widely done.
Yeah.
And it's a no-brainer when you figure it out.
For sure.
Right?
So I think the takeaway from this is, as cheesy as it may sound, like, live your life like a stream. If have faith and trust that if you're generous and you give, that the Lord will replenish those resources and continue to be faithful as he always is. So on that note, we wanted to switch from talking about charity and then getting into, we're talking about tax planning and QCDs and donor advised funds. For years and years and years, right? The 401k came out in, I think it was like 1980. January 1st, 1980 is when the 401k legislation was passed and in place. And
I think you're right.
That was like when it started. And that was really the beginning of this whole idea of, which has been 401k has been a phenomenal vehicle and has been one of the best ideas that has ever come out in terms of, personal wealth building and savings, right? Yep. Phenomenal vehicle. So this is not to say anything against that. But from a planning perspective, for years and years and years, it was, hey, you're going to be a lower tax bracket in retirement, right?
Yeah.
It was just assumed.
Yeah.
And so if that is true, if you're going to be a lower tax bracket in the future, you want to defer as much income as you can now by putting it in a deferred compensation plan, a 401k, whatever it may be.
Anything that's that way,
And save the taxes now. You'll be in a lower bracket later. So when you take the income out and have that income, it'll be taxed at a lower percentage, right?
Right.
And in the situations where that still could be and is true, it still makes a ton of sense.
Right.
Right. If you make a high income, you're in a higher, we're in a progressive tax situation, right? So if you make more income, you're taxed at a higher percentage. If you're a higher income earner, then that absolutely still makes sense to some degree.
Yeah.
But what we've started to see over the last handful of years is, I think for a combination of reasons, and I've been talking for a while here, so I'll hand it off in a second. But for a combination of reasons, we've started to see this shift. I think you can even tie in like the national debt situation and just kind of the American state financially. This assumption that tax rates will be lower in the future, even if your income is lower. Like there's more and more people that are like, I don't know if I agree with that. Like I could definitely see a situation where, I'm at least in the same tax bracket that I'm in, even if it's not higher.
Well, this election that just happened was one of the biggest topics was taxes, right? And the fear if Kamala got elected, the taxes would go up, and the euphoria of Trump getting elected was that taxes would go down or stay the same. But it looks more and more like taxes will stay the same. There's a few little things he's going to throw in there, like wages will not be taxed if he gets his way and all that kind of stuff. But it doesn't really affect the overall tax environment that much. It's not going to go lower, I guess is the point. And this is the most favorable outcome of the election, that taxes won't go lower. Then chances are over the next 10, 20 years, the chances of taxes going higher are very high. If you think about it, like this is the best situation for taxes, and they're not going to go lower. They're going to be maintaining. That's the best scenario in this election. I would say that with our government debt and all the things that are looming, yes, that is different today than it was 20, 30, 40 years ago, that you would think that taxes would be lower. That the assumption that tax brackets will stay the same is, if you asked, when we do seminars and stuff, we ask it's one of the questions we ask in the audience, and hardly anybody thinks taxes are going down. Right. As a population, we all think, for the most part, that taxes will be going up. So this idea that deferring comp is a great idea for taxes is kind of gone by the wayside a little bit in that regard. it's still important, obviously, to use these plans. And I'll tell you why I think the most important piece of these plans, and something that has been added, I'm going to get a little bit off topic, not quite, but there's a Roth piece in 401ks that's now a big deal, right? And if your 401k offers a Roth, that's a different scenario, right? It's after-tax money that goes into the Roth 401k, but it grows tax deferred just like a 401k. The difference is when you retire years down the road, it's tax-free.
Right.
Now, that to me is powerful. If you have a Roth 401k option, that's to me the new thing that is great. But if you don't, it's still good to have the discipline to save money through a 401k, even if the taxes are the same. The other side to that, usually most companies, for example, Walmart, their 401k has a 6% match. So, if taxes were the only incentive to do a 401k, then maybe that's gone away. But no, it's not the only incentive.
Sure.
The ability to get free money, if you put in 6, Walmart gives you 6. Well, you have to do that, right? You have to take free money when you can get it. So even though the tax piece of that is maybe gone away a little bit, and we don't know that, right? Taxes could go down 20 years from now.
Yeah, none of this is known. I mean, none of it's guaranteed. There's all planning. I think, there's a lot of value in giving yourself flexibility down the road, not having all of your eggs in one basket, not just from an investment perspective, but in terms of, what is the tax status or situation for this account in the future?
Yeah.
And is it subject to future taxation? Is it tax-free? Is it in a trust account or joint account that we're just going to pay capital gains on? And I think having, assets in different buckets, diversification investment-wise makes sense, but diversification tax-wise makes a lot of sense. And so if you look at, the difference between, we get asked the question, should I be contributing to my Roth 401k, my traditional 401k, Roth IRA if I can, or whatever it may be. If it is strictly 100% a tax math problem, right? Because if you assume the same tax rate now and in the future, the outcome is identical. Right? And I can, kind of walk through that math, but the outcome, if you save taxes today and let it grow, or if you pay taxes today and let it grow, if you assume the same rate of return and the same tax rate, it's identical.
The only difference is highly compensated people would pay less because they would take money out. They'd take less out, right? They would lower their bracket, but the brackets would stay the same.
Right. I'm just saying about the calculation of like, if so what it boils down to is, what are taxes now versus in the future, either for your individual situation or just across the board. And so, you don't want to overcomplicate it beyond that. Like that is really what it boils down to in terms of, should I be contributing to Roth or deferring this income into the future? And so, not any overarching point that we're trying to make other than just, it makes sense for a fair number of people out there to not put all of their money in deferred
100%.
accounts, right? And start contributing to Roth accounts, non-qualified accounts on the side, trust, joint accounts. And giving yourself flexibility so that if you look up and it's like, well, shoot, tax rates are higher and I'm retiring, you have options.
Exactly.
You have the choice to, I can take money from these accounts. I don't have to take it all from a taxable account. David always says the fact, like a 401k, any kind of tax deferred vehicle, it's a jointly owned account between you and the IRS, right? And I think it's not a horrible way to look at it, right? Because they own a portion of it. They just haven't told you what portion that is.
Well, and lay it out like as a planning side. So let's say we're meeting with you and you're 50 years old. You've got 10 plus years until you retire, and all of your money is in a 401k at this moment, right? And we're visiting with you. We're going to go over the ideas of, okay, maybe there's some other buckets, to your point, the Roth, if there's an option there, the non-qualified, if there's an option, so that when you retire, not all of your income doesn't come from that one taxable source. So if you need $100,000 a year to live, and you're taking it all from 401k because that's where all your money is, all of that is taxable. Where if you plan correctly, maybe you only have to take $50,000 from that.
Right.
And $50,000 from other sources, and then only $50,000 is taxable, and it lowers your taxable amount. One thing right now, 'tis the season of Walmart deferred compensation plan time of year, and I'll meet with several clients of mine that are Walmart, at the Walmart deferred comp plans, and I get asked a question all the time: is it the smart thing to do or not? And it's the same math equation.
Right.
Taxes we don't know. One thing I like about the deferred comp, though, is just for highly compensated people, they can put more in than they're allowed to through their 401k, through their other sources, right? So it's just a way to get more deferred. It doesn't change the taxable event. You're sharing that with the government. You're still going to pay taxes on it. But I also think it's a discipline scenario.
100%. And that's where some of the value of just the 401k, the automated nature of some of these retirement plans that you have through your workplace. The more you can automate, set, forget, not think about, the better, because it's hard to do when you have to make a decision every time to invest, or I'm going to save this money. So you need to automate that as much as possible. And, it definitely is different for everybody, because if you're making $500,000 a year and we only need 120 when we retire, the chances of you being in a lower bracket in the future are still quite high. Right? But if you make $150,000 a year and you still want, we want $120,000 a year to live off of in the future, you're probably, there's a good chance like you'll be in the same or very similar tax bracket. And so those are the kinds of situations where you really want to look at how much value is there to deferring the income today to a future date.
I think one of the keys is discipline, because if you defer, give an example. If you do a 401k plan, I always tell people, if they're young, they're new in the workforce, whatever, they've got bills and they've got family they're trying to raise potentially and so on, it's hard to put a lot into 401, into deferred, because you need that money.
Sure.
But if you can be disciplined and say, every year I'm going to increase my percentage by 1%.
Right.
By the time you're there for 10 years, you'll be maxing out. You won't even know it by the time you get like 10 years down the road, and you will not feel it because you're getting pay raises and so on, and you will not even know that you've done that, right?
Right.
So that's one little trick you can do. But on like deferred comp, if you defer part of your bonus or part of your salary, it's just a discipline. You're just putting money away that otherwise you would probably spend.
Yep.
Right?
Yep.
It magically, how money comes in our bank accounts, if we don't put it somewhere, magically it gets spent, right?
Yeah.
Some way or another, we as human nature, we spend it. Deferred comp plans, 401ks, all that stuff is great, more for discipline than sometimes just the tax benefit, potential tax benefit.
So. Yeah, absolutely. Well, that's all we've got today. Charitable giving and some tax conversation. So
riveting stuff.
Pretty short conversation. Well, we hope you guys have a great next couple weeks. Enjoy the Christmas season. We appreciate you guys, and would appreciate a like, comment, subscribe. We always keep our eye out for those. So we appreciate you guys, and we'll see you next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. Mach 1 may only transact business in those states in which the firm maintains a notice filing or has qualified for an exemption or exclusion from registration. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com. Thank you for listening to the Market Moment podcast.